Good evening and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby Kinzer.
And I am Thomas Doty.
And we're here every Thursday at 8 p.m. coming to you with a whole boat of information on how to manage your finances and to become wealthy. That is our hopes for you, because we definitely know that knowledge is key to anyone trying to build wealth, especially generational wealth. Welcome, everybody. I just want to remind you, if you can click on the like button and the heart button, and that gives us a lot of traction. And if you have any kind of comments, or we like questions too, or clarifications on things that we're doing, please put it in the comment box, because it helps us, you all, expand and get a greater audience with Facebook and YouTube. So we really appreciate you doing that. So last week we talked about estate plans and wills, and if you missed it, you can go out on YouTube, and you can go out on Facebook under the FITT Show, FITT, capital letters, show, and get any show that we have archived. And I guarantee you, this information never gets old. It just keeps getting new and fresh, just like money. So, Doe, why don't you tell the people what we're going to be talking about today?
Okay, Bob. One of our faithful viewers asked us, how do you pick a stock? So today's show is dedicated to providing you some information that will help you make an informed decision on picking a stock. It's not an easy task. Don't think we're going to give you this great tip and it's going to be Facebook 5 years ago. That's not how it works. But if you put the time and effort in, it can be very profitable. It's not an exact science. There's no guarantee that you're going to be successful. But I have found that being patient, doing my due diligence, and having some luck, I have made a lot of money. You don't need a degree in finance. You don't need to be an accountant or a CPA. You don't have to have an extensive background in business. What you do have to have is the desire to do research and stay abreast of what's going on in the stock market.
Well, Doe, hold up for a minute. Hold up, man. So, Doe, that all sounds good. But I believe that most people, their attitude is that it's this, picking a stock is just too complicated, or it's too risky, or and their fears deter them from wanting to invest, and so they miss out and they minimize their potential opportunity to grow wealth. I think they think it's too complicated and it's going over their head. That's what most of my friends tell me, and they choose not to get into the investing game.
Yeah, I think that's partly true, but I also believe that most people want to make money, but they don't always do what's necessary to make money. And a lot of that is time. I think people get caught up with, their kids, their families, their church, and don't really have the time to keep up with what's going on in the market. So many things pull people in many different directions. As a retired person, I have a lot of time to invest in it. So I spend a lot of time doing it, and I've been successful. If you carve out the time to do it, do the research, you can make a lot of money doing this. Now, please understand, there's a lot of ways to pick stocks. We're just going to recommend what we have found successful for us. So the first thing Bob. So the first thing you do in picking a stock, as we've talked about in many of our sessions, the first thing you have to do, decide what your goals are, what you want your portfolio to achieve. Set your goals. The other thing you have to do is give your money time to grow and let it compound. The three different basic types of stock that we're going to talk about tonight. The first are income-oriented stocks, and those are stocks that typically pay a pretty healthy dividend. So we're going to call those income-oriented stocks. The second is what's generally called the blue chips, and we refer to those as wealth preservation stocks. Those stocks pretty much hold their value. They're stable companies, companies that have been around, and they're pretty solid. And the third type is capital appreciation stock. Now, those are a little bit riskier. Those are aggressive growth stocks, emerging companies, maybe some IPOs and those types. But those are the three types that we're going to talk about. And that's the best I can tell you about the three types of stocks that we would invest in.
Next, though, I think people need to pick an industry that interests them and explore the news and the trends that drive that particular day-to-day information. What I mean is, if there's a particular product or that you use, that you follow, then why don't you go and look at, some of the trends, go look at some of the information. Or if you know about, say, the cars, and about, you're interested in Tesla, go and explore and look. And there's so much information now with the internet, though, that you can find out a lot about that company and what they're doing and that kind of thing. And that's what it means by pick an industry that interests you. Like I said, if it's cars or if it's tech, like Microsoft or Amazon, look at those things, but then go out there, stay aware of the daily news out there, and just follow that company. It's not that difficult because there's so much information that you can get. So that's what it talks about when we're talking about pick an industry that you're interested in, because 9 times out of 10, if you're interested in it, you're going to go further and want to know more information on that particular company.
Hey, Bobby, just to add a little bit to that, you might want to pick the industry that you work in. It may not be the most interesting, but it should be something that you know about, something that you have some information on and some expertise if you've worked in that industry for a while. So as Bob said, you pick an industry and then you look for the leaders in that particular industry and you do your research. Find a stock that meets your goals, and you have to make sure that the risk tolerance ties in with your goals. And we'll talk a little bit more about that in a minute. And then you pick the stocks that match, what you're looking for as far as risk. If temporary losses or fluctuations in the stock market keep you awake at night, then you might want to concentrate on lower risk options. If you can weather the storm, the setbacks, and you make your mind up that you're in it for the long haul, then you can pursue some aggressive long-term growth. And that's how you make money. Go for a little more aggressive stocks.
Makes a lot of sense to me. But so many people are timid when it comes to investments, especially the stock market. They just get, fear. Fear is a big deterrent in why people don't invest. And we try to just provide you with some information you want and reduce those fears, because that's the name of the key, though. There's information, and there's so much out there. And the point is, if you're able to manage your own funds, who better to trust than yourself?
That's for sure.
Though, I want to talk about how to research stocks. Now, there's several different ways that you can go about researching the stock, but one of them I want to discuss is fundamental analysis. The fundamental analysis is usually the average investor who looks at, the economy and look at the overall economy and look at the industry and the conditions and the strength of those markets, or the financial strength and the management of the companies that actually, excuse me, they look at research. For instance, a lot of times fundamental analysis is basically looking at the financial statements. Now, you may not be a person that know about financial statements. For the people that do, though, it's good to look at that. You look at the earnings, the expense reports, you look at the liabilities, look at the cash. That's and to be accountant to understand if they have a lot of cash and low debt, that's pretty good. But if they have a whole lot of debt and you look down at the cash and there's no cash, no cash, that's what fundamental analysis sort of look at. It also looks at like the employment rates, how it affects the industry that you're looking at investing in, or inflation. You know, all of those kind of things are demands on companies. And also look at the types of products, actual products and services, and the demand for those products and services. That's what is called fundamental analysis. It looks backwards of what they've done, and it also looks forwards. But it definitely looks backwards, which is a little bit different than technical analysis.
Okay, and I'll tell you a little bit about technical analysis. Now, mostly traders do this, and that's why it's not something that I've ever done or I ever used to buy any stock that I've purchased. But traders attempt to identify opportunities by looking at statistical trends, movements in the stock's price, what their volumes are. They look at all types of analysis that help them try to figure out what the stock's going to do in the short term. It uses charts, looking for patterns that identifies a stock that's going to go up. And their focus is generally short term, but obviously they also look at some long-term trends also. And that's not something that the typical trader a typical investor would use. That's a little more technical by its name, technical analysis. But there are some apps and tools on the internet that you can use that does these types of things. Obviously not as sophisticated as what the traders use, but it can kind of mimic some of the things that they look at, which might, again, help in your decision in determining which stock you want to buy.
And like just a couple of methods which to research the stock on, but definitely, do you also use like what are they called, stock letters, or what are those letters that are called that
Yeah,
people get
I use
and gives
Kipling's
them
letter. Yeah, I use the
food and
Kipling's
stuff like
letter,
that?
and I also subscribe to the Motley Fool. They provide information on stocks. They do a lot of the technical analysis and then provide it to you. And everything else I do on my own based on what I feel, things I see. Just like you always say, my gut feel. I've I look at what
Gut man strikes again.
yeah, but it's worked.
So,
It's
so,
been very, very successful.
so, Doe, what is the most recent stock you and how did you do?
What'd you say, Bob? I missed what you said.
What is the most recent stock that you purchased and how is it doing?
I bought a stock on August 5th called Upstart. It was part of the Motley Fool's recommendation. And August 5th, I bought it at 133. And today that stock is selling at about 333. I'm up about 200 points on that stock. And not to imply that everything I buy does that good, because it's done. I also bought some Alibaba maybe 8 months ago, and it's down. It might be down around 30 points, but that's like the only loser in my portfolio right now, and that's more a function. Again, that's not because I'm good, but it's because the stock market has been going up like crazy. It's hard to pick a bad stock right now. I probably have a total of 11 stocks, and I've got one loser. And my biggest winner is Microsoft. I've owned that for almost a year, and I'm up about 45,000 on Microsoft. And it's funny. We did our show a couple of weeks ago on is the bubble about to burst, and the market went down like 7 straight days after we did that show. I think we were starting to feel like, hey, we know something and everybody else doesn't know. But it's recovered the last 2-3 days, and that's how it's going to be. It's going to be peaks and valleys. You have to be patient. You have to look at the long term. You have to pick good stocks.
So you said a couple of stocks. I want you to just qualify them. Tell people what Alibaba was, so you know, so
Alabama,
they know the type of stock it was.
that's
Then
like
tell me
China's.
about what Upstock is.
Yeah, Alibaba is like China's Walmart is the best. Not Walmart. Amazon is the best way I can describe it. But
Amazon.
it's got caught up in some of the government issues that are happening in there, and that's what's really driving it down. But for me, that's a long-term play. I won't think about selling that. That's a stock I expect to hold, 2, 3, 4 years and see how it does. It's a gamble, but I mean, I think I got about 20 grand into it, so it's not something I'm going to sell unless I decide to sell and need to cover some of my gains. The stock I bought, Upstart, when I looked at my portfolio, I didn't have any stocks in artificial intelligence. And so the Motley Fool recommended a couple of those, and I looked into this one, and it just seemed like it was poised to do well. I had no idea it was going to do this well. Again, that's where some of it's luck. But I did do some research and looked at the financials and saw that it had a pretty good chance to do well. And so that's why I bought it. Some other stocks I have some of the basics. I mentioned Microsoft, I have some Amazon, I have some Apple. I think a couple of shows ago, I told you I bought Peloton because it had a big hit several months ago. And so many people I know have Pelotons. I figured they're going to go for a while. I got a stock called DocuSign, which I bought because when I refinanced my house, it was the process they used to close on the house. And it was just so smooth how it worked. Did a little research, found out about it, and decided to buy some of their stock. And that's pretty much what I do. And again, I have a portfolio that I manage myself. It's about $500,000, but the majority of my money is handled professionally. This is money that I can play with if I lose it. And I say that kind of in jest because there's no way it's going to go to zero. If it's going to go to zero, then we all got bigger problems.
We got bigger problems than
yeah. But
exactly.
the money I have professionally managed, that's kind of what I'll live on, and not what I live on, what I bank on, and that's handled by people who do that for a living that I pay and expect to do well.
So, I purchased this NXP out of Sweden, Holland, get mixed up, Sweden, Holland, and it is a semiconductor, right? And the reason why I got it because back when the iPhone 7 was coming out, there was a theory that when the iPhone first came out, everybody was looking to invest in the iPhone, Apple, because of the iPhone. But they said what they missed was should have been investing also in Intel, because Intel was the semiconductor chip that runs the iPhone. Apple does not make semiconductors. So I went and researched this one semiconductor company that was getting ready to go in iPhone 7. And so I said, oh, wait a minute, let me jump into this, because if it's going, and Samsung has started making their own similar, but they were talking about maybe Samsung. So anyway, I jumped on it. It was doing well, though. And what happened was it ended up being the semiconductor in almost a majority of the cars that are in the world, like Mercedes, Lexus, Nissan. I'm like, wow. So you just never know. But it interests me, and it made sense to me that if this is in the iPhone and in the Samsung phones, I mean not the Samsung, Android, maybe this mug can make some money, and it did. So anyway, just wanted to take a moment to give some real live situations that we did. And that brings me to those, how you were talking about the different stocks you had. And let me preface this, you all. And don't correct me if I'm going off the rails. Anybody can do this, but it's not easy. Anybody, like we say, you don't have to be rocket scientist. You don't have to be no great mathematician to do this. but you have to do your due diligence and do the work, have the patience and the time to research, to read, to go out and search. You too can do this, you all. Because the reason why we're having this show today is because nothing, I think, is nothing better to me is what I teach in financial education. You control your money, don't let your money control you. So you need to know about your money. You can't lose what we're talking about today, because if you choose somebody else to do it or you do it yourself, at least this information is going to be helpful for you. And I just want to make that statement, though, that because a lot of people think that,
Bob, you still with us? Yeah, I
I'm
agree with
still
you
with you
100%.
now. It's kind of like
Yeah, no, I agree with you 100%. And again, it's you may think it's easy to say this because we've been in a bull market for a long time, that the market has done really well. But even if it does correct the long term, if you've picked good stocks, you should do okay. And I think Bob's mentioned before, you're never going to generate wealth investing in savings accounts from what the bank pays you. It's got to be stock market, commodities, or home ownership, or property. Those are the ways you can generate wealth. And you may not be able to do it with a large sum of money, but you can do it nowadays. A lot of these broke apps you can buy $1 worth of Microsoft. You can buy $10 worth of Apple. You can buy $50 worth of Amazon. You can buy small amounts of stock and just gradually add to it as you can. It's just an easy way to do it, to invest. And those are stocks that most people buy. I'm not recommending anything. They worked for me. But you do your due diligence and you find out what's a good play, and you go forward. But unless you do, that's the only way you can generate wealth is by doing that. And it's not something you don't expect to buy a stock and have it go crazy and you make a gazillion dollars overnight. That's not what we're talking about. The stock I talked about earlier, Upstart, that's one of the few stocks that has gone up 200 points for me. And again, I just happened to hit it at the right time. So I mentioned some of it is luck, but
we always talk about the long play, you all, because the market always readjusts and balances itself. It does. So the long play is ready. So that brings me to this, because you talked about the different stocks. You got a lot of different stocks there. And I want to talk about one of the things in picking a stock is also having a diversified portfolio of stocks. Because if you're a conservative investor, then a small portion of your portfolio should be into less riskier stocks. Now, if you should group percentage stocks and like blue chips, some losses. But that's the key to picking stocks, is that you also have a diverse portfolio of different stocks. When one is doing good, the other one might be doing bad. Then the other one might be bad, could be end up doing good. That's the thing I have what they call a mixed balance of stocks. So when you pick the stocks, look at having a diverse, and then always remember, it's important that you understand your risk tolerance.
Yeah, and Bob, just to add to that, let me add to that before you go further. When you talk about diversifying, we talked about picking one particular industry. You pick another industry, that's diversification. You pick another type product, that's diversification. If you get into it, and this is something that I do, is you might even look at, okay, the US market is going crazy right now. You might look at buying a European stock or an Asian stock, just because their cycles are going to be different than the US. But that's another form of diversification. The more diversification you have, the better you are able to withstand these corrections that we talk about, and it's very unusual for everything to be doing bad. That's typically not going to happen. So as Bob mentioned, sometimes things are going up, things are going down. If you have everything in the same type industry, then you are more susceptible to big decreases in your stock prices. I have a lot of technical stocks, so yeah, I am definitely at risk, but I feel they're real solid companies that are going to do well over the long haul. And again, this is kind of my play money that I'm doing it with, and so I'm being a little more aggressive. But there's a lot of ways to diversify, and you need to have a diverse portfolio.
That is the key. And the old saying, though, that helps bring it home, don't put all your eggs in one basket.
That's for sure. That's for
So
sure.
there's 5 key factors that we want to focus on picking a stock.
Yeah, and the first, I mentioned this earlier when I talked about income generating stocks, and that's dividends. That's a powerful way to boost your earnings. You go in and you look for stocks that pay a healthy dividend, and companies that have paid that dividend for a long, consistent time. And they're out there, and some of them pay like 5%, 6%, and they've paid it for years. And they're pretty good stocks. So not only do you have the dividend, but you also have the opportunity for growth. And just so you know, when a company makes money, their earnings, there's 2 things they can do with those earnings. They can invest in the company, or they can pay the money out to their shareholders in the form of dividends. So when you look at, typically the tech companies don't pay a lot in dividends because they are reinvesting and putting money into research, putting money into new products. So they don't have a lot of money to pay shareholders. And that's not a stock you purchase expecting to get a large dividend. But if you look at a company like Verizon, they pay about a 5% dividend. And again, the great thing about dividends is you also have an opportunity for growth to go along with that steady stream of income that you have coming in.
Yeah, that's very dividends. A lot of people talk about compound interest, but they don't talk about compounding dividends, where you get your dividend and you leave it reinvested, and like your dividend grows off a dividend, like compound interest, where interest compounds over interest. Dividends can compound over dividends, and that's another way to grow income.
Right.
Another factor, another key indicator is the price earnings ratio. The price earnings ratio is the company's current share compared to its earning per share. So, for instance, a P/E ratio of 15 lets an investor knows that they're willing to pay $15 for every $1 of earnings per share. Right? And the P/E ratio is considered, one of the best indicators of a stock's value, because you could see a P/E ratio of say 50, and that means that they're actually charging you 50 times more than what the actual earnings per share is. It's called sometimes overvalue, and sometimes you can tell with the P/E ratio, if it's very low, that it's undervalued. Now, it can go either way with you on determining whether that's good or bad. Sometimes overvalue is not earning, and they can charge that much because their stock is that attractive, because they have future high expectations for that company. And undervalue may not be bad. It may mean you can get in at a cheaper rate. A cheaper cost. Indicators just when you the actual share price compared to the earnings per share. It's giving you a value of the stock. So PE ratio for one industry could be 160% in healthcare, may not bad, but a PE ratio in the auto of 15, that may not be bad either. It depends on the industry. But it gives you a chance to compare how it's doing compared to its competitors.
Okay, next thing we want to talk about is beta. And beta indicates the volatility of a stock in comparison to the market as a whole. For example, a stock with a beta of 1 means it will react just as the market will react. So if, and by the same token, a stock with a beta of 1.2 will react much more aggressively than the market as a whole. So this goes back to understanding what your risk tolerance is and determining which betas you're looking for in your particular stock. By the same token, a stock with a beta less than 1 is going to be less volatile than the market. That might be where you want to be in a particular situation. So you got to decide if you want a stock that pretty much moves with the market, or a stock that pretty much moves faster than the market, that means more risk, or moves less volatilely than the market, that means less risk. And the other thing to look at in relation to beta is what the analysts think about that particular stock. In every stock that you buy, there's going to be some kind of report that shows what each analyst or what several analysts feel about that stock. And you'll see words like they're bullish on that stock. They recommend a buy. They recommend a hold. They're bearish, which means they recommend sell. And those kind of things play a part in your decision. And it's just, those are the experts and what they feel about that particular stock. So you look at beta in addition to what the analysts feel about that particular stock, and that can help you make a decision on whether you should be buying that stock or not.
So then you have earnings per share, the EPS. And the EPS is just a dollar figure representing the portion of the company's earnings after tax and after they pay preferred stock dividends, because that's the difference between common stock and preferred stock. Preferred stocks pays dividends. And that is then the actual dollar per share is allocated to each share of common stock. So what they're telling you is the earnings per share, just what it says, how much that company is making over that period. And that's why you look at the earnings per share.
Okay, the last thing we're going to talk about is historical returns. That's the performance of stock over a period of time. That's a scorecard. That's just keeping track of what has happened. Doesn't tell you what's going to happen in the future. It's just telling you what's happened in the past. But if you look over the history of a company, that's going to tell you whether their earnings are growing. It's going to tell you what rate the earnings are growing at. You can look at their cash, what their cash is doing, what their debt's doing, all those types of things. And again, you look at those in relation to how they stand within their industry, or how like companies, what type of information they show you. You look at the cash ratios and see how they compare to their competitors or to other stocks in that particular industry. But history is a good source of information to see the trend of how a company is doing.
Yeah, and that's well, they also say in the business when I was a broker, past performances are no indicators of future returns, and that's their little out. But looking, like I talked about earlier, the fundamental analysis, that's what it does. It looks at the past performance, and that can give you a little bit how they've been managing that company. Because if you look at the 1 year, they give you the 1 year, the 3 year, the 5 year, 10 year. And the more out you go, the more history you have. Like we said before, it doesn't mean in the future that it may do that, but at least can give you an indicator of how they've been running and give you some indication of the movement and direction that the company's going. So that's why historical returns are very important to look at. I mean, guaranteed, they do is something to pay attention to. No, I just want to take the moment and say, if all of this is TMI, okay, some people are sitting on here talking about thinking this is not just TMI, WTMI, way too much information. So let's say you don't want to devote time to researching and following the information we provided. You should consider a portfolio manager such as a mutual fund, which is another name for mutual fund is management company. You pay a mutual fund or ETFs, exchange traded funds or index funds, and even a financial advisor. But my portfolio manager, which is like what they call a mutual fund, and like index funds, and what they call it, passive managed funds, because the company is really managing it for you. And if that's, you don't want to pick your own stock, you don't want to, do the research, you don't want to put the time in, you don't want to take the patience and the risk tolerance that it takes, then maybe you're the one that might just need to hire a financial advisor. But like I said before, though, even if you do choose this route, you still need to understand what they're doing with your money. You just can't give your money and walk away and don't know what's going on. You got to check on your money. You need to understand what they're doing, what the risk tolerance is, what market is in, how much risk they're taking with your money, how much fees they charge, because the higher the fees, that's taking away the amount of money that could be earning for you. So I know we gave a lot of information about picking a stock because there are some people, we know this is not for everybody, but we think you need to know it so you won't be so much in doubt or so much in fear. But it is so rewarding when you can understand this and feel comfortable in what you're doing and being able to do it at night. So with that, dope, I want to bring you to our final takeaways for the night.
Okay. First one, obviously, do your research. I know you got a lot of things you're pulling at you as far as your job, your family, your church, your activities, but it's an opportunity to make some money if you do the work, put the time in, and it will be profitable if you put the effort into it.
And I know you all are probably getting tired of being Doty saying this, but reason why we're saying this because learning is repetitive. A reasonable rate of return can be expected only with a long-term horizon. That's where we talk about the long-term play, talking about having a financial goal and a long-term horizon. Because over time, the market can return itself.
You got to diversify, have a diverse portfolio. And again, choose the right asset class allocation strategy that works for you. You don't want to do what other people are doing because you don't know what their situation is, what their risk tolerance is, whether that's their play money, whether that's their money they live on. So you have to take the time to diversify, make sure you understand the risk and know where you are, know what risk you can live with, and move forward.
Hoarding cash is not an option for investors because inflation erodes the real value of cash. We talk about the time value of money. People need to understand that it is counterintuitive to create wealth if you think you can do it with just savings, putting money in a savings account. Case in point, at a rate of 3%, of inflation rate of 3% per year on $100,000 will be worth just $40,000 in 30 years. Let me say that again. At an inflation rate at 3% per year, $100,000 will be worth just $40,000 in 30 years. And that's the concept of time value money. $1 a day it's definitely not worth $1 tomorrow. That's why a lot of young people, that I ask them, what would you rather have, $1 today or $1 tomorrow? And the answer would be $1 today, because at least you can invest it and try to outpace inflation, because $1 tomorrow may not be worth that. That's why you can't be just hoarding. You need to think about investing.
Yeah, and we said this, picking a stock is not as difficult as you think. It's not that hard. Whether you choose to self-manage a portfolio or you choose a portfolio manager, or you do what I do and do a combination of both. The key is still to acquire knowledge and understanding so you have control over your investments.
Yeah, that is so important, Dote. And I was kind of a little bit skeptical of this show this week, because I knew it was going to be, for some people, so a lot of heavy information, and talking about fundamental analysis, technical analysis. But we need to have this conversation, because you can do it. You can do it. The main thing we want you to do, knowledge is key, man. Understanding is the key to having a wonderful and enjoyable life. The more information you get. Yes.
Nothing worthwhile is easy. So it takes work, it takes time, but you get nothing if you put in nothing.
That's I remember an old lady told me that, if it's that easy, 9 times out of 10, it's not even worth it,
Right.
So I want to thank everybody. If there's any questions, please put them in the comment box. And before you log out of this, hit that like key as many times as you can, and that heart button. And we really appreciate that. And we'll be here next week, same bat place, same bat channel, Dope.
And if you have a subject you'd like us to discuss, let us know. If you'd like clarification on something we've discussed, let us know. We're only here to help you.
Remember, and if you've missed several shows, if you missed it, go back out there. They're archived on the FITT Show, FITT Show, in videos. And, we are, we really, really, really appreciate y'all listening. So with that, peace be with you, and we look forward